What happens when a major real estate investment firm starts losing market love? At Insightful Value, we dig into the numbers and stories behind beaten-down companies, and today's spotlight is on Kennedy Wilson. The stock has been sliding, but is the market overlooking long-term value? This video is for informational and educational purposes only and is not financial advice. Now let's get into it. Kennedy Wilson is a global real estate investment company with operations in the US, the UK, Ireland, and Spain. Their focus is primarily on multifamily and commercial properties, and they manage over $22 billion in real estate assets. They're not just landlords. They buy, develop, and manage properties with a value-add strategy, targeting underperforming assets and repositioning them for better returns. But despite the breadth of their operations, the stock has been under pressure. Higher interest rates have hit real estate firms hard, and Kennedy Wilson is no exception. Debt costs are up, cap rates have expanded, and that's put pressure on valuations across the board. The company's latest earnings reflected that net income has been weaker, and they recently reported a decline in cash flow from operations. Revenue took a dip year over year, primarily due to fewer asset sales and a more cautious investment pace. From a value perspective, however, the picture gets more interesting. The company is trading below book value, and their recurring income from multifamily properties remains solid. Their dividend is still intact, offering a yield that's north of 7%, attractive if it holds. Management has also been reducing leverage and selectively buying back shares, which could signal confidence from the inside. The strategy seems to be one of consolidation, preserving capital, trimming weaker assets, and positioning for when rates eventually ease. But in the current climate, investors are understandably skeptical. The market tends to punish real estate players in rising rate environments, and Kennedy Wilson's recent underperformance reflects that sentiment. Still, for long-term investors with an eye for real assets and steady income streams, this could be a classic case of short-term pain, long-term opportunity. At Insightful Value, we specialize in finding stories like this, undervalued companies the market has cast aside. We break down the data, simplify the jargon, and help you make sense of where the real opportunities might be hiding. Whether you're new to investing or deep into value strategies, our goal is to bring clarity and insight. If you want to explore more companies like Kennedy Wilson, visit insightfulvalue.com for full breakdowns and analysis. So, is Kennedy Wilson a value trap or a misunderstood gem? Let us know what you think in the comments. And don't forget, subscribe to the channel and check out insightfulvalue.com for more deep dives into the companies no one else is talking about.